Hi everyone, my name is Kush, and this is the Elevate podcast, which is designed to empower CEOs, entrepreneurs, and business owners on a range of topics. We hope to bring you lots of practical insights today. And today I'm joined with Julie from Wilkinson Accounting Solutions, who specializes in mergers and acquisitions. And it's a real pleasure to have you here today. I hope that we can extract all of your valuable expertise on the accounting and finance side, which will be amazing for our listeners. So it'd be great to know more about you if you just want to introduce yourself.
Yeah, thanks, Kush. So like you said, I'm the owner and founder of Wilkinson Accounting Solutions. My background is I'm actually a chartered management accountant by trade. I came from 20 years in corporate, and I started Wilkinson Accounting Solutions really because I saw there was a bit of a gap in the market in SMEs, not really having valuable insight into financial information. I did a survey when I started the company. I asked 20 businesses between sort of 50,000 turnover and 20 million what their accountants did, and 100% only saw their accountants once a year. And I think, especially when we're talking about selling and buying businesses, you need access to more real-time information. And within that, so we have a tax and bookkeeping team, but our consultancy side probably delves more into corporate finance, where we help with cash flow planning, investments, funding, and obviously M&A in terms of exit planning, corporate governance, and then sort of buy and build strategy with post-integration. So yeah, lots of different things we help buyers and sellers with.
Yeah, that's amazing. I think you mentioned one thing about clients only seeing their accounts once per year, and how they should have different types of financial information, over and above that, I guess. What does that look like in terms of financial information that companies should have and businesses should have in place over and above just looking at their accounts and speaking to their accountant once per year?
Yeah, well, I think if we're looking at sell side, I suppose it does become relevant to buy side, because once you buy a business, you might be selling it in the future. But if you look at sell side, I mean, typically we'd be thinking people should have in their mind that they want to eventually produce what we'd call a seller's pack. And the seller's pack would typically start with a board pack. And I know sometimes it sounds a bit corporate. I'm not saying it has to be 100 pages long, but I think there is a reporting cycle that I think most businesses should follow, which would be forecast or budget, planning what you want to do for the year, which should include financial and non-financial KPIs, which should be bottom up budgeting, including management into that process. So one of the key things is, do you have a management team to help you run the business? Um, at that point, you then need a good accounting software. So, Zero or QuickBooks could be good, or the other, depends how large you are, you might need a full ERP system. And that should be a bookkeeping process where you can run reports to get information from your chart of accounts quickly, and then you should be comparing management accounts, actual versus budget, so that you can. So your management accounts should be actual versus budget versus prior year, so you can compare how are you tractioning towards plan, but how are you comparing to last year as well. And then we'd expect at least 12 weekly cash flows, which would be weekly produced, and then other KPI reporting that you can cascade to relevant team members. So, it could be trading KPIs, it could be customer engagements, whatever your industry is really, it'd be specified industry KPIs.
Okay, yeah, and I mean, in terms of the topic that we're on, in terms of preparing a seller preparing to sell their business, um, how far in advance should sellers be looking at this? And is that something you support with?
Yeah, we definitely support with that. I mean, I think businesses should be starting to think really from the time they set it up. I mean, I think everybody in business eventually comes to an exit. That's either unfortunately through you're forced to through ill health, or personal circumstances, or through retirement. Now, for some people that might be 30 years off, but the thing is, it's harder to get things in place when your business gets bigger. So it's good to be starting to think about it slowly as you set it up. But at the end of the day, if you haven't, and you not, and you've got an established business, and at the end of the day, you just have to start. So you have to start somewhere, and you take it in stages. So what we typically do is, if we're working with someone that's been trading for a lot of years and doesn't have the reporting in place, we would initially do, we've got a bit of an exit discovery session where we would come into the business and just stop and look at where are they, like what systems have they got, what reporting have they got, have they got the mechanism to be able to get reporting quickly, or is there work that needs doing to get it? Because you have to start somewhere. And then we'd put a bit of a plan of action in place of how you'd set it all up.
Okay. And that's really, really interesting. And obviously, my understanding is that you act on sell side and buy side, which is useful, or is it predominantly one or the other?
No, we work on both. Not, we wouldn't on the same
Sure,
transaction,
of course.
but I suppose it just depends. If we come in on the buy side, we do typically come in, at a buyer's transaction, and then we'll work with them long term. I suppose on the sell side, it will be a business that will approach us at saying, "I do want to sell in the future, not just yet, but I want to get set up." So obviously, it'd be at a separate stage, and then I suppose what would happen is we'd help the seller with their information gathering, help them implement what we would call a corporate governance strategy, so they have a good process, controls and systems to allow the information to flow, because that's effectively what financial information is. It's how does information get from one team to another team through a system to then an output that is readable and understandable. And I think an owner needs to be able to have that where they don't necessarily the only people that analyze it. Because if you want to step away and the business run without you, which is how you maximize the asset of a business, you've got to start letting other people take accountability for the reporting. And that's what a finance team does. A finance team effectively helps business owners implement the robust reporting that is usable to all the different departments in the company.
Yeah, really interesting. So, of course, on the sell side, if you're a seller preparing to exit, so the seller's, thinking, maybe in the next 5 years or 2, 3 years of exiting, and with you coming in, understanding both sides of the equation, what is it that buyers are looking for? I mean, obviously the financial information, which you've mentioned before, but what is it that they're really like looking at within that financial information, I suppose, and how does that vary throughout an acquisition, say? Because obviously, then keeping that up to date might be a challenge as well. I don't know.
Yeah, well, when the buyers come to look at, I mean, we're obviously looking at eventually it's a valuation, which is typically the past 3 years average profit EBITDA or an adjusted EBITDA if there's adjustments with a balance sheet. So I think you have basic principles in accounting, which is where, good bookkeeping is the foundation to all accuracy, really. That's the most important thing. And too many people try and do their own bookkeeping or put inexperienced people on bookkeeping because, yes, I know systems these days link the bank. So you think it's as easy as pushing a button. But actually, I mean, I would say we probably see about 100 balance sheets a month. And on average, I'd say 98% of them don't reconcile. And there's always a minimum of 10% risk. And that's because people aren't doing it real time. They're not using the accruals principles, sort of matching income to costs. And all this sort of thing is important because then it comes to trends. So you do have a 3-year average profit. I suppose the reality is when people are buying a business, they are buying it for the future. They want to build on that basis and have a future. So sorts of things the buyer would need to know is sort of trends of the business, which is why you want accurate, up-to-date bookkeeping, because there's no point in having 11 months of wrong data and then forcing it all through 1 month. Because when they come to start asking you things like, well, what's your seasonalities? Where are your peaks? Where are your lows? You're never going to know because you're going to force it all through in 1 month. So that's why you want to get accurate monthly reporting. I suppose people sometimes might start with quarterly when they're smaller, but as they grow, they might move to monthly. And I would definitely say probably within the last 6 months before you sell, you'd want to have definitely monthly in place because they're going to want to see. Because also then when they're in the transaction and months go past, they need to see real-time information. So you've got to be able to produce the monthly accounts.
Sure. Yeah. I mean, from our side, we get involved with clients if they're not already our clients selling at a much later stage when the headline deals may be agreed or about to be agreed, that kind of thing. So we don't really get involved with the financial negotiations. But in terms of those negotiations, if there are accounting information that needs to be produced, for example, if you get a client that comes in, there's no management accounts, or they're not, or not for that year, or whatever, that kind of thing, or they're not monthly and they should be. Do you support with that, even if you're not doing their kind of annual accounts or statutory accounts because it's for the purpose of the exit? Is that something that you do?
Yeah, we would be able to. I mean, statutory and management accounts are different to statutory accounts anyway, because statutory are normally for tax purposes. Theoretically, they should roll into one. So if you're doing good monthly management accounts, the year end should be easier because it's more from the tax perspective. But yeah, no, we would help because ultimately, if they've got that gap, it is a different role, and there is normally a gap between bookkeeper and year end accountant because there's a lot of skills within finance. And I think you don't know what you don't know. And that's why I think my corporate experience brings a lot of expertise into SME businesses, because although corporate might be over the top or people might feel I'm not a big corporate, you can actually bring good. There is some things within a corporate structure, I think, that works well in SME business, especially things like hierarchy of structure, controls and governance. Because ultimately, when as your business grows and you've got employees and stakeholders, you do have a duty of care to those stakeholders.
Absolutely.
To minimize your risk of error and fraud. Because ultimately, if you go under, you might have liabilities you've got to pay, you've got staff you might have to let go. So I think you do have to start thinking more of a business owner corporate rather than just a one-man band sort of lifestyle business, because you start having a duty of care to other people.
Yeah, that's so important. I think so. As you're starting to scale, it's not you should be doing this with you should be having more financial controls in place. This is your duty actually to do that, and that's a really good way to put it, I think.
Yeah.
So I mean, we're experiencing it ourselves as we grow, and we're starting to perhaps start to scale things a little bit. So we're seeing that in our controls and stuff, and we're obviously reinvesting to make sure they're all fit for purpose. So that's really, really interesting. And I think that, as I say, we get involved at a later stage, which I think we were going to come on to another topic in terms of when or if a price or headline price is agreed, what then the next step is, and at what point do you need to come in? At what point does the solicitor need to come in? People, if you've not sold a business before, or it's your only business that you're then selling, you've worked your whole life, you've really got to get this right. So part of that is getting the right deal team and advisor team around you. Do clients ask you a lot about that because you perhaps get involved earlier than we do?
Yeah, and I think there's a lot in terms of selling business. There is the financial transactions to consider, but there's lots of other departments, from a legal perspective. I think sellers starting to think about their contracts, not just their contracts with customers and employees, but probably suppliers. If you've got a lease and things like that, like looking at the right time to sell. I mean, this is probably where solicitors in your area comes in, is, if they're looking at renegotiating leases, obviously they're going to be asked for that paperwork when they get to. So having good administration can save a lot of time. So if you don't have an administrator that's helping you maybe get one and things like that, because then they can help you start saving and filing all of the paperwork. I mean, I don't know what you see in terms of contracts, but I know that when we deal deals, often people can't find the paperwork.
We see it all the time. And sometimes it's quite key paperwork. We've got a company sale at the minute which relies heavily on royalties received from sort of IP arrangements and that kind of thing, and it's been quite difficult for them trying to source all the right agreements, or maybe the agreement is not in the correct company name, and this is all coming out in the due diligence side, which we'll come on to shortly. But it's just so important, and these things can be sorted prior to the sale and in the lead up to the sale. But yeah, we see it all the time. It could even be that there's a key supply contract, which has a termination clause if there's a change of control of the company. If that's not known about before, you can't deal with it. And if it crops up in a due diligence exercise, then you're then going to be panicked and sort of say, "Oh, I'm going to have to go to this supplier, our key supplier, and try to get them to agree to our change of control," which they may not do, and that can affect value. That can affect value in the company. So, and then in terms of leases, I can't even tell you how many times we see problems with leases. If the business is reliant on its premises as well, which is the case in certain sectors such as childcare, nurseries, and dental, that kind of thing, there's always going to be a premises attached. And if it's not a freehold interest and you've got a lease, you're always going to need that lease, and that is a key asset. We see a lot of issues crop up there, whether it's just it's not been drafted correctly, or the client thinks it's a lease, it's not a lease, that kind of thing.
And I think where we have, when we talk about corporate governance, what we're talking about is controls to safeguard the business effectively. So the types of things in contracts that we would say that people don't think about might be, if you're importing goods from China, the amount of people that don't really even know the Incoterms are on. So things like what method of transport, are you duty delivered, DDP, because that's really important for where your insurance ends. Now, a lot of people just think, oh, it doesn't really matter, but I've seen boats sink. I've worked in retail. I have seen it where people have lost 500,000 worth of stock and then they're not insured because they don't know what their actual insurance terms are for those products. And the thing is it might never happen, because that's with any insurance, isn't it? Any insurance is there and it might never happen, but you've got to start deciding where do you need to safeguard, because if it did happen, what's your biggest risk? And that's one of the things that we would say is important. From buy and sell side is risk planning. We have to scenario and risk plan, because ultimately, I suppose, everybody takes a bit of a risk maybe, and you've got to choose what level of risk you're willing to take. But if you've never thought about it, if you've never even documented, well, what are the risks to my business? Which is where probably like SWOT analysis would come in. When you look at strengths, weaknesses, opportunities and threats. We do SWOT analysis for buyers when we do due diligence, but why can't a seller have it? This is what we would say is part of a seller's pack. A seller's pack should be everything the buyer asks for should be there in a bit of a pack, maybe like a PowerPoint or whatever it is, in a PDF document, so when the buyer just sees it, like, oh my God, here it is. And when they ask the question, you've got the answers, and that's what we would be recommended is best practice for sellers. I do think sellers are quite far behind in the UK. Compared to like the US, for instance, and planning for exit. But ultimately, deals still need to happen. So if the seller isn't prepared, that doesn't mean someone wouldn't buy it. But the seller's got to then be open to what is my business worth, because I haven't safeguarded these things. And even if it doesn't drop the value necessarily, but it maybe it's got to have a more relaxed payment terms, payment plan of that deal to allow for people to put these things in place. Because there's so many things within a business that can, just one thing goes wrong and it could be the end of a customer not paying, insurance not paying out, not being insured. These are all the things. And this is what we would call corporate governance. Corporate governance is looking at the risk of your business and saying, what do I need to put in place to safeguard it from major risk catastrophes, basically.
Yeah, corporate governance, really, really important. As you were telling the story about the insurance, it made me think of something about, not even maybe owning the goods before they've been like paid for example, that kind of thing. And if there's the buyer doing some due diligence and they're looking at your terms, and they're saying, oh, actually, you've got this much product and you don't actually own it, has it been paid for yet? Because maybe there's a clause, what we call like a retention of title clause, in the terms of your shipping or whatever it is. Even that kind of thing, understanding your contracts, and that all goes around corporate governance as well. So really, really important point. And all these things can crop up on a sale.
Yeah.
So,
And they do. And then it comes down to the due diligence the buyer does. I mean, we do speak to a lot of buyers. And I think one of the problems is it is hard because buy sides, there's a lot of courses out there teaching no money down deals. And I think what it's enticing is people to try and go into doing acquisitions with no money. But the problem with having no money is you don't always get the best service, because ultimately, at the end of the day, if we're talking about this safeguarding and corporate governance, if a seller hasn't put it in place, then do you want to know as the buyer the risk you've got post acquisition? And people will often try and cut due diligence or do it themselves or do it quickly. And I've seen it. We've gone into businesses where they've done what they thought a quick DD, by quite experienced business owners. And then there's lots of problems. It can take them 6 months and 100 grand to actually fix the problems. So I just think, people need to start. There's a lot of things around due diligence where you want to sort of, I would say, if the seller can't give a SWOT analysis, you'd want to at least do one yourself, to break out what risks and opportunities you've got. Because ultimately, in the end, financials are the things that are always impacted, either in time, cash, or profit.
yeah.
Those three things in the end impact cash flow. Because when something goes wrong or takes more time, or you need to put something in, you'll probably have to pay for it. So planning, I think, is one of the most important things.
Yeah, definitely. And it's interesting, people can be so focused on getting the acquisition done that they're not necessarily paying attention to, or dotting the i's and crossing the t's, on the financial side, and thinking, oh, well, and the legal side, but thinking, what does this look like after the acquisition? We were talking off air before just about how, if there's a no money down deal, for example, and the meeting repayments to the sellers following completion can then have an effect on the financial aspect and the performance of the company cash flow, the company after completion. It'd be good to hear some thoughts on that as well, because as you were saying before, really.
Yeah, I mean, I find it fascinating, really, that this no money down deal, and I understand it, and it can be done because I've seen deals with little or no money down. But what I don't think people are truly understanding is, what they're basically doing is they're going into the acquisition thinking, oh, I'm just going to use the business to pay for everything. But we now have to sit back and logically think, well, most businesses aren't more than a 40% net margin, probably somewhere between 25% and 40. So if you're doing a deferral over 2 to 3 years, first of all, it doesn't matter what financing you've got, whether you leverage asset financing, cash flow financing, or seller financing. Ultimately, that business is now having to pay back at cost that it didn't previously to the purchase, because the seller wasn't paying back a loan of any form. So that has to reduce the cash flow over the first couple of years in a business, because now you've got to pay it back.
Yeah.
So obviously it helps the buyer, because the buyer might not need their own capital to put in, but that once they've signed on the dotted line and they're now the owner of this business, now they're responsible and safeguarding this business. And actually, you've got to be open-minded to think, but what is paying back that loan doing? So that's why cash flow planning in terms of your due diligence is key, and risk planning, because you've got the business as it was being sold. Hopefully the seller will have a forecast, but the forecast is going to look a lot different, isn't it? Because now in the new forecast world, you've now got this loan to pay back, probably 50k of deal fees to pay, if you've used brokers, solicitors, finance brokers. And if the current owner was working in the business, which often they are, and you've got to replace them, you've now potentially got recruitment fees to replace them, potentially a point of 3 to 6 months where you've got to pay 2 people, because you can't just hand over overnight. And all of these things have to be taken into consideration. So I think the seller should be thinking of that further down the line, knowing, because obviously if the seller can get their role replaced before they go to market, some of the issues go away because it's already there. And if they haven't, then they've got to be open to thinking, okay, my business is still a good business. It's still going to be worth it. But actually, I've got to be realistic here and know that I might have to be a bit more lenient on the payment terms of that deal, because at the end of the day, it doesn't benefit anyone if that deal is drawn out of cash and it just disappears. Yeah. It doesn't benefit anyone. A lifetime of work building a business and cash flow going down the drain is what will happen. So, I'm all for getting a good deal, and I'm not saying you can't do a no money down deal, because I think you can, but I do think that doesn't change the fact that that business might need some working capital cash flow, and there is a risk potentially post acquisition, especially on the seasonality of the business, which is why the planning of it is so important.
I completely agree with you. And actually, I would go one step further from the legal side. I'm not sure if many people know about this, but doing a no money down deal and then using the company itself to effectively finance the purchase price can actually be a legal risk. If, for example, so you're using the company's money to pay for the seller's shares effectively, rather than your own money. So you're going to have to draw that money from the company, presumably on like a loan account or something, pay it over to the seller. And if the company is struggling with cash flow following completion, and ultimately that results in an adverse situation where the company, say, goes under or whatever, then that's quite risky, because all of a sudden you're an acquirer, you've used company funds to pay out to the sellers, and that hasn't been good enough to keep up the survival of the company. So as the directors of the company, new directors of the company, effectively the buyer really, can then be on the hook for that. So, if there's a liquidator appointed, that kind of thing, because the company couldn't survive those payments, then that can be legally risky, and it's something to watch out for in the acquisition process. And if we're acting for sellers, we always make sure that the sellers retain no responsibility going forward. And there's specific ways of dealing with that. It's something known as actually financial assistance, because which used to be completely illegal. It's not anymore. You can do it, but you have to be aware that the company has financial responsibilities, and if you're using company money to effectively buy the shares from the seller, which is the case in a no money down deal, of course, that's where the money, if it's sort of company financed, you just need to watch out for that legal risk, and your advisors should be putting in appropriate mechanisms to protect you against that.
Yeah, and I think it's so important because, you know, and not just the cash flow, like you can sustain the cash flow, you know, I've seen it done. And if you have your good cash flows and stuff, but also as the buyer, like, why do you want the sleepless night? Ultimately, it is going to put strain on the business. I know myself, I've done acquisitions myself. It is hard in the first couple of years after the acquisition. There's no point lying about it, you know, and the cash flow will be tighter for that period of time. But, you know, obviously, the more you can plan and know in your mind, the easier it will be, because I see the stress that people go through. You know, it's all right, these no money down deals and these courses, these people aren't with these buyers 9 months down the line after the acquisition. I see what it's like for those people, because that's when some people will come to us basically nearly in tears. Oh my God, I don't know what to do. The business is going under because of this. And it's because ultimately, you know, yes, you've done a no money down deal. Great. You got the asset financing because you've bought a business with lots of assets, but there's only so far asset finance can be leveraged. You know, like, you know, if it's a property, generally you can only get up to a 75% mortgage, 35% deposit needed. Where does the 35% deposit come from? You know, that might come from the cash flow of the business. Well, if that mortgage wasn't there before, that is now gonna dint into that cash flow. So I just think it's about understanding the risk associated to doing different scenarios. Because ultimately, once you sign on that dotted line, like you say, that buyer is now responsible for safeguarding that business. And now they have the ethical duty of care to run that business. And if they've just done it haphazardly in due diligence and now signed it, and they've now bought this business, you know, it won't probably be the seller that's now in fault. Even maybe if the seller was at fault originally because they didn't have safeguard it in the first place, well, that's what you're trying to find out as part of the due diligence process.
Yeah, absolutely. So I guess moving on then, in terms of the cycle of a deal, heads of terms. I know that there's, you know, you can get them drafted up, sign them, and move on, or you can kind of spend too long on them sometimes as well. What do you get involved with drafting the heads of terms? Because obviously, sorry, not drafting them, but sort of negotiating the structure of the deal, I suppose. Is that something that you get involved with?
Yeah, we would help buyers. I suppose on the sell side, if we were going to work with a seller over a long period of time, we'd help them get to the point where they knew their valuation. Obviously, the buyers then got to negotiate the deals. I suppose when we work as acquisition CFOs for buyers, what we do is we help them. Well, first of all, we'd be saying to the buyer that they should have their own plan. You know, it's quite interesting, really, the amount of buyers that will sort of pick on a seller's financials. Oh, it's not accurate, that's not accurate. But yet then we go to forecast and consolidate, and their own accounts aren't reconciling. And that's quite interesting, because it's like, well, you know, you've got to practice what you preach, really. You know, are you actually ready to buy if you don't even have your own books in order, is something that I would say. But anyway, once we get to that point, we'd be looking at a top, probably, I would say, for heads, if I was going to help someone with it, the best practice would be a top level consolidated cash flow. So you understand top level, what can the business afford, because that helps you do the deal structure. Then you'd have the valuation of the P&L, and then you'd have the decisions over excess cash, working capital, and sort of buying the balance sheet. They're sort of like the three sort of elements that I would say. And I think it depends how well the seller's books are on how you would then split that out in the heads. But I definitely think the buyer should have their own consolidated cash flow before they go to heads of terms, because otherwise, how do they know if that deal structure they've offered will work? And all it's going to do is cause problems later down the line if it's not going to work. Or the worst case is they don't ever know it's not going to work and still close the deal anyway.
Yeah. And what kind of conversations are you having at the moment surrounding heads of terms? What are kind of like the hot topics on that when you're talking to clients?
Well, the biggest issue I see is people trying to do their own, not getting the financial expertise to negotiate the deal in the first place, not necessarily using the solicitors to write the heads of terms. A lot of people will phone me and say, oh, can you do me this? Which is fine. I've got a bit of experience in heads of terms. You know, we do help people, you know, make sure they've got the exclusivity in. I would recommend if you're buying the balance sheet, you don't put the number, you put the workings. But then people just phone up and go, oh, what's the working? What working do I put in? It's like, it's not, yes, there is a set balance sheet, but it won't always be the same, because ultimately there might be different things that stand out. You know, for instance, if you've got a high level of invoice financing, that might be a bit of a red herring that you might want to look out for. So I do think the biggest issue, and this comes down to people trying to cut costs. Buyers often aren't wanting to spend any money before they do the deal. But at the end of the day, if they go into due diligence trying to do their own heads, there's likely they might spend more money in the due diligence process anyway, because they're not prepared in the first place. So I think the risk is people just trying to not using the right expertise. And that goes for different areas: legals, finance, probably HR.
Yeah, absolutely.
As well. I think I would say probably one of the three keys, and maybe even IT potentially, depending on what business you're buying.
Sure.
Yeah.
Sure. Yeah, definitely. So I think that we probably experienced similar things where you've been involved with heads of terms documents, and it maybe hasn't had the right legal support. We've definitely been involved with heads of terms where it hasn't had the right financial or accounting support or other support, that kind of thing. So it's really, really important that if whether you're acquiring or selling, you've got a good advisor team on your side to work together as well. You know, we often receive heads of terms that have been signed or are about to be signed, and the financial aspects of the deal haven't really been structured correctly in our view. We're not tax advisors, we're not accountants, but ultimately we're the ones that got to draft these documents. We've got to negotiate these documents, and we like to gain an understanding about how the price has been formulated as well, because it gives us practical insight into maybe how warranties might be negotiated, or limitations or caps on claims, that kind of thing might be negotiated, to give us that negotiating understanding, and it is an advantage. So it's really good to get the advisors, I think, together at an early stage before heads of terms are signed or substantially negotiated, because you're going to set your deal up very well, and avoid having to reopen issues as well, which we often see, and that causes delay and extra cost. So if investing in the right heads of terms and with the right advisors, there is a point where it can be a bit over the top, which you want to avoid, but that's what the advisors are there for. They're there to sort of say, no, let's move on now. We've got enough of what we need. Would you agree with that analysis?
Yeah, I do. And I think it's hard. I mean, I just think one of the most important things is that buyer and seller, and I think are aligned from the start. And I think bringing the advisors in early doors is quite important, because they can help. I mean, I think, because I see it too often where the accountant's trying to go to the solicitors and the solicitor's trying to give it back to the seller. I mean, ultimately, each advisor is specialist in their area. So maybe it's either group calls, or the advisor, I think, should be talking directly with buyer and seller on the same call. I don't understand the secrecy.
Yeah.
Like, at the end of the day, the financials are what they are, probably similar with the contracts are. And there doesn't need to be secrecy around it. Ultimately, the most important thing is that seller and buyer are on the same page. Now, obviously, as much of that needs to be drafted in the heads. I suppose we're not the legal. So from our perspective, we help them. We help the buyer sort of negotiate with the seller. Our aim is to make sure they're both aligned, and the seller being realistic on the adjustments. And they understand why we're saying don't put the number on the balance sheet. Like, this is the risk to the balance sheet. The seller needs to understand that too, because the biggest issue we see is where numbers move from heads of terms to final, sale agreements. Yeah. And what I think tends to happen, seller often then thinks they're getting a bad deal, because typically the balance sheet does drop, in my experience, because it's usually debts that aren't recorded properly, especially taxes and things like that. So it does usually drop, and then they can start to think, because I've seen it drop way over 500,000.
Oh wow.
Yeah, spare cash dropping 500,000. So they obviously then think, oh, I'm getting a bad deal, they're trying to do me out, but they're not. They just didn't have their books in order in the first place. And we are seeing more though now, where we see the buy side and the buyer asks us, what do we think is the risk? And it's just so messy. The thing is, accounting can take, if this is years of poor accounting, it's not something we can fix in a few weeks. And we have seen scenarios where we go back to the seller and say, look, it is in a mess, but the seller really likes the buyer really likes the seller. We're like, well, will you stop then and let us sort it? Give us 3 months, let us sort the bookkeeping, have a a clause against yourself, that buyer's got the right to buy and you've got 6 months to sort it. And then let's fix it and get to some base level where you've got the information, because that is one of the problems. If it is messy and they can't explain, it's not always something you can turn around overnight. And in the end, probably buyer's got to make that decision. What risk is the buyer? Because the seller just wants out normally. It's the buyer that's probably then taking the risk if the books are not in order.
Yeah, I think that's really good insights, especially in terms of the communication aspect between seller and buyer. I mean, we're a strong, we strongly advise jumping on a call or some kind of video call and collaborate whenever possible. I mean, you can negotiate in writing and then go through the whole process, due diligence, and then issues crop up, and what ends up happening, you all jump on a call and try to resolve it because you've got so far through the deal. Why not bring that straight forward? Do it at the outset. Everyone knows each other. There's rapport, and there's more likelihood that when issues, or if issues do come up, then it's more collaborative than the opposite of that. And that's only going to promote strong deal making, I think. And there's a common interest there. Obviously, buyer and seller, they're on opposite sides of the deal, but the common interest is to get that deal done on terms which seller's happy following their sale, acquirer's happy once they've come in and the integration, start their integration process. So it makes sense.
And I think sometimes, if I'm honest, I think what often we see happens a lot is the accountants get involved, because when there's poor bookkeeping, there's a bit of secrecy. If we notice things, because they've been with the people, sellers have been with their accountants for years. Yeah. And I just think, I mean, I've had lots of things say to me. I get people say things to me like, well, you know what it's like. This is accountants. You know what it's like, do you just tell them what they want to hear or they go somewhere else? I've had people say that. I would never do that. I've seen scenarios where we're talking about the accountants actually doing the bookkeeping, but they're like, well, because they won't pay for management accounts, we only post it anywhere and sort it out at year end, which is just as bad as not doing it. It's pointless. It's pointless to do the task if you're not going to do it right. And this is why I think, sellers, because I'm not saying the accountant isn't doing a good job, and I'm not saying the business owner has to necessarily move away from the accountant from the year end. But ultimately, the accountant, maybe their experience isn't in corporate structure, isn't in corporate governance, and isn't in exit planning. And I just think, that's why maybe use a different advisor. Getting a third-party independent review as a seller could be quite useful earlier on in the stage to see whether, what does a third party, because also when someone's done the accounts for a long time, there might just be things they miss because they're so used to the account. So
I mean, that's quite a big step for a business owner, I would say. In my experience, when we've either had a conversation or identified a need to bring in like another advisor or something like that, it brings some level of anxiety, because the accountant that a client has worked with for a long period, the trust levels are through the roof. I mean, understandably in certain respects. So I completely get it. So what would you emphasize to business owners, just to kind of understand that potentially maybe there is a need to bring someone, maybe a more specialist in exit planning like yourself, and not necessarily using the accountant that's been sort of doing the accounts every year?
Yeah, I mean, the first question I ask is like, do they understand it? I have got some masterclasses that I run understanding financial statements, and business owners will say, oh, I trust my accountant, they save me tax, I understand it. But when we come down to the actual accounting principles of the financial statements, probably the balance sheet more so than anything, I'm like, do you actually understand it? They don't, because, not some do, but 99% of the people I speak to, you pick a number on the balance sheet, something out of the ordinary that's not the bank, for instance, and say, what is that? And they just they don't know. So, maybe that's the relationship you've got with your accountant and you haven't needed to know, and that's your decision of how you work with the accountant. But I think when you're going to sell the business, you've got to have a different understanding, because you've got to accept that the buyer, if you want maximum value and a quick deal, maximum value and a quick deal is going to come from having good understanding, good reporting, real-time information, which maybe the current accountant isn't doing. And sometimes the accountants admit, I don't have time capacity to do it as well. So I would say the first place we start, we would never try and overshadow the account. We work with lots of accounting teams, because the accountants are good at what they do, but they might not have capacity or the resource or the skill set to do some of the more complex areas. So we would normally typically come in and do one of our exit discoveries initially, and we would just assess where it is. How, what do, in terms of like more of a month end accounting is what I would say, because I think most accountants are okay at the banking and VAT returns and things like that. But it's more the accruals principle, making sure you're matching income and costs, like making sure sellers understand accounting principles, especially when it comes to things like IP, intangible assets, fixed assets,
Sure.
things like those sorts of areas. Businesses don't often understand the logic behind what they're doing. And they often think, oh, I don't need to. But I had someone come on my podcast, Fiona, who actually said that she thinks she tripled the value of her business by understanding financial statements.
Wow.
Because at the end of the day, no advisor is with you 24 hours a day. And sometimes you have to make a quick decision. And surely it's better to have a good grasp and be able to make some of those decisions yourself and understand it rather than just always relying on somebody else.
Yeah, that's a really good point. Yeah, that's a really, really good point. So I think in terms of structuring a deal, we were talking about heads of terms, and we're talking about how you can support there. In terms of like the common points or clauses that you would want to see in the heads of terms before, I mean, would you normally introduce a legal advisor, or would you? Many of your clients have already got those sort of outfits in place.
Not everybody. Sometimes people come to us about them. So obviously we would suggest them, because I do think heads of terms is probably more of a legal document.
Yeah.
Our element of it is normally just deal structure and valuation, which, at the end of the day, we would advise what we find. We would probably expect the legals and the solicitors to then word it in a way that protects them, because obviously that's not our forte, is like the legal wording. So I think really the thing I see most about heads of terms is people not really understanding the importance of them. So, for example, and this is probably something you can shed a light on more, is like exclusivity, for instance. I have seen quite a few people that have done their own heads that haven't had exclusivity in there. So because my understanding is that's the part that's legally binding of the heads, isn't it? So maybe just give a bit of a breakdown of what's legally binding and not in the heads.
Sure, absolutely. So, I mean, heads of terms is effectively the document that sets out what I call sort of the skeleton, the broad skeleton of the deal itself and all the principles. So, the headline price, maybe like timing, whether there's any going to be warranties given to the buyer to protect the buyer from skeletons in the closet and post completion. And yeah, as you say, really, it's the lawyer's job to kind of draft those and negotiate those with support from client and other advisors. In terms, heads of terms aren't normally legally binding, so they're not legally binding. So that what that means is, if you're an acquirer, you're acquiring the business, the seller can effectively walk away from the deal for no reason, unless you have protection in there. So it's quite common, although heads of terms themselves aren't legally binding, it's usual to have a few clauses in there that are, because, well, if these particular clauses weren't legally binding, there'd be no point in having them. So one of which you've mentioned, which is exclusivity. You're about to embark upon an acquisition, you're going to invest huge resource, management time into exploring this acquisition and trying to make the deal work. So you need to feel confident that your seller is not negotiating with another party. It's not just going to withdraw for no reason. And it's usual to have a certain period, which does vary, to be fair, where they can only negotiate with you. Now, you would want that to be legally binding in the heads of terms, because heads of terms aren't legally binding. So you have to make that clause binding so that you can rely on it in law. The other type of clause is, I guess, confidentiality. Usually, as an acquirer, you'd want the fact that you're acquiring or looking to acquire this company to be confidential. So it's normal to have a legally binding confidentiality provision in there, so that the parties can't go and speak to third parties or anything about the deal without each other's consent. Normally, you just expect it to be purely confidential, and those are sort of the main things that you'd want to be legally binding. I think heads of terms generally also have some moral weight, actually quite a lot of moral weight. So, for example, you've negotiated your heads of terms, you've signed them, you spent a period negotiating them, and then to try to change your position or materially change your position on what you've already agreed can damage the trust quite a lot between the parties. So it's really important not just to pay attention to the legally binding clauses in the heads of terms, but all of them, even though they're not legally binding, you're not bound by them. You can change your mind, etc., etc. But you should still pay attention to those because it's very difficult to change the goalposts unless there's a very good reason to do so. I mean, it does happen from time to time, but that's why it's important to make sure that the clauses are in there, even if they're not the binding ones, if that makes sense.
Yeah.
So yeah, I think just again on the exclusivity point, because it is that important on the acquisition side, if a seller were to breach the exclusivity clauses, well, what happens? Well, okay, you can claim against them for your out-of-pocket expenses, etc. But normally you'd want to have an actual statement in there to say if the seller withdraws from the transaction or breaches the exclusivity clause, that then they have to reimburse your costs, that kind of thing, worded in a legal way, which the solicitors would advise on. It is worth thinking about that just for extra protection, and then the sell side kind of at least know, and it's there in writing to sort of say that they can't just withdraw, willy nilly or whatever. There'll need to be a very good reason to do that.
Yeah. And then I'd be the types of things sometimes that people like to talk about as well at the heads of terms, which maybe, because I think it's hard with the financial sometimes, because this is where it does come down to the seller, because in the end, it's how good are their books.
Yeah.
And I do think sellers are a bit naive and they try and they don't have the information. Well, then you've got to decide at the buy side, is it even worth doing the deal? Because if they can't give it to you ahead, is it going to change in due diligence? However, non-financial things that I see discussed is sellers will say things that I want to keep my employees, I want to keep the systems. You've got to keep the premises. I mean, maybe there's a legal contract in, and this is because the seller is, they've built this business from scratch, and it's their baby, and they care about their employees and things like that. Now, so these are the types of things at heads. I mean, some sellers might not ask for it, but if they are starting to say these sort of things, then it's obviously something you want to start thinking about at the heads, because like you say, what you don't want to do is just go yeah to them, even if it's not in the document, because they also say, and then get to it. Whether it has to be in the document or not is irrelevant, but if they're asking you these questions, it's something you should have in your mind, and conversations you should be having, I think, before you sign them. Because ultimately, if you just promise the world and then go back on everything you say trying to sell their shareholders, it's likely to either, well, worst case, throw the deal, or or delay and lengthen the deal, because you can't then come to negotiation. And I've seen it on a lot, especially on financials. But that's why I think it's really important to have the conversations with the sellers earlier on, because if the accounts are in a bit of a mess, the seller is where they are and the buyer has to choose whether they go on. But as long as everybody knows where they are, and you could probably even write something in the heads if it's really bad, just to say we are going to have to, and it could change the deal materially or something like that. As long as both parties know, then you're on the same page, aren't you?
Yeah, but it's really important to, as you say, put a note in the heads of terms.
Yeah.
These aren't legally binding sort of statements in the heads of terms, but it's really important to have that in there just for the mutual understanding, to kind of say, because when something crops up, it's kind of, okay, what do the heads of terms say? And if there's just a line in there, I mean, you can't just pop it in there. You should discuss it.
Yeah, you
and,
have to discuss it.
Yeah, reflected in the heads of terms.
Yeah.
Um,
Like when I did my deal, I signed my heads in one day.
Okay, great. Yeah.
Because we had all the conversations. Don't get me wrong, there's lots of conversations to and fro and back, but ultimately we all had to make sure we're on the same page. So when we got to signing the heads, there wasn't all this about towing and throwing, I don't want this, I don't want that, because we'd already discussed all of the, they had said what they want, I said what they want. Sometimes, you have to negotiate, you have to come to a compromise.
Sure.
But we ended up signing ours in one day because there was no undiscussed issues. And I think if you're going into something feeling there's an undiscussed issue, but on both parties, it shouldn't be being signed. You need to go back to the drawing board and have those discussions.
Yeah, absolutely. I can't tell you how many times I've seen it where heads of terms have been signed. There's maybe an acquirer paying on a deferred basis, which sometimes happens. It could be a no money down deal on the one hand, or it could just simply be some kind of retention, small retention, that kind of thing. But the discussion hasn't been had with the seller about security. And then when they get advice from their solicitor, it's kind of like, okay, you're not getting all this money up front. What's your security for this money? We see it a lot. And it's just not been discussed. And I do get concerned by that sometimes. I don't know whether it's just because, well, maybe it's more of a legal point. But I think if you ever don't receive your full price up front, there's a risk you
Mm.
may not get it. And that's what we say to clients if we're acting on the sell side, for
Yeah.
example. But even if we're acting on the buy side, we will say, have you mentioned this to the seller? Because as soon as they appoint solicitors, they're probably going to be advised to seek some kind of security from you for their deferred or their installment payments, that kind of thing. I guess it's slightly different in a situation where, like an earn out situation, where the payment out to the seller over time is based on the future performance of the business.
Mm.
But I suppose it's still relevant to an extent, but it is more relevant where the price has actually all been agreed and fixed up front, to have those conversations. So yeah, promoting that communication is critical to a successful deal.
And I think, I mean, I would say, if I'm honest, the state of the seller's books, I do think earn-out clauses are probably welcome in a lot of cases, because at the end of the day, it's both parties, isn't it? Like the sell side, at the end of the day, as the buyer, you have to show the seller that you can run a business, because ultimately you are saying to them, I'm going to take on and pay you this deferral. And sometimes I think the seller could get a bit worried if they're all these no money down deals, because it's a bit like, what, you're not going to bring anything to the table to secure the business I've spent 20 years building. I don't think it shows good faith, if I'm honest. However, it can be done. But then on the sell side, though, you have to accept that you can't just sell a business and expect a buyer to pay all up front and give you the maximum price when you haven't got it ready. You know, if you are still working in it, nobody wants to buy a job. They want to buy an asset. So you've ultimately got to realise, if you're at that point and you want to sell it, fine, but go into it knowing, well, I'm working in it. That probably does mean I'm going to have to stay on, or I'm going to have an earn out, because why wouldn't the buyer ask for that?
Yeah.
And I don't understand why advisors on the sell side, like people like accountants and other advisors they're working with, will tell them otherwise, because surely it's obvious that if a buyer wants to pay, if a buyer doesn't want to work in that business, which often they don't, because they might not even be the specialized skill, that role will have to be replaced. So to start adding back and deducting dividends, things like that, where you know you're taking a salary because you're working in it, it just doesn't make any sense. And it automatically shows not good faith, because the buyer will immediately not trust it, because they're showing something that they can't explain. Whereas if you have this seller's pack that I'm talking about, and it's all in there, and you've got the adjusted EBITDA and all the reasoning, you know, it really does go a long way, especially from good faith from the buyer. So I think both parties have to show good faith. I think the buyer needs to show good faith, you know, that they're all in, that they can run this business, that they've got their own ducks in a row, you know, with their own forecasts. Because I think it would be fair for a seller to sort of think, well, ask, have you got your own forecast of how you're going to run this business? Because why not? Why wouldn't the seller want to know that from the buyer? But then on the reverse side, the seller's also got to be able to show, well, here are my forecasts. Because at the end of the day, they often are trying to sell it on the future of the business. Oh, I've got this coming. It's like, well, prove it then. But then what they will then do is go away and scramble for a forecast. And if I was the buyer, I'd say to them, well, show me last quarter's forecast and the actuals against it. And often they can't, because they don't have it. So this is why I do think it starts with the sellers getting ready first, because it helps the whole process. But the buyer, if the buyer owns a business now that they've maybe organically ran, then they can't expect the seller to be set up all in this way, and then they can just have a business that isn't set up in that way, because why should they expect the seller to do something that they're not doing themselves?
Yeah, I think,
So I think it's both ways, you
Yeah,
know, it's
both
just
ways.
morally right that if you're expecting one person to do it, the others. And I'm not saying there'll never be errors or you'll find anything, but I think the principles in place is what I think is important.
Yeah, there's a few kind of themes that have come out then really in this part of the discussion, which is effectively being organized as early as possible. Perhaps putting, if you're a seller, maybe putting the buyer's hat on and thinking, well, what are they thinking about, and how am I going to get my business ready to present it in the best possible way to them? That's going to benefit me in maximizing value. And if you're a buyer, maybe thinking about what the seller's thinking, what the seller's worrying about, you know, it's their baby, all that kind of thing. And then moving on from that, it's communication is key. Having those conversations, opening up the dialogue with the advisors as well, as early as possible, and making sure you have had all the relevant conversations. And then, of course, making sure you've got the right advisors to work with. So, I mean, certainly, if whenever we're instructed on a deal, the first thing we would do is reach out to the other side, effectively the other party's advisors, and try to establish that rapport, because we just know the importance of it. Even if just picking up the phone, just wanted to introduce myself. We hope to work with you, etc. It just goes such a long way.
Yeah.
I think if the parties themselves have that kind of dialogue too, is really important. I guess then moving on from that, we touching upon sort of like the due diligence process, I suppose. So, do you, my understanding is you support acquirers in their due diligence process.
Yeah. So if we've worked with the seller to get ready to exit, we'd do be on the sell side due diligence, having the pack, everything ready. Obviously, if the buyer approaches us, we act as the acquisition CFO for the buyer. So yeah, we'd help them on their due diligence. So we basically do financial, operational, and tax.
Okay.
Are the areas of due diligence that we look at.
Yeah.
Now, that would be our full package. And the reason we suggest commercial and financials done together is because there are a lot of the commercial questions will eventually impact the cash flow. So when we go back to all this risk planning, scenario planning, and corporate governance, like safeguarding the business, that all does come around the commercials. But in the end, the commercials is what impacts the cash flow.
Yeah. I guess like things like debt recovery, recovering invoices, that kind of thing is, I guess, a big part of that. The procedures, I mean, for that, what the process in place for that kind of stuff is relevant, I guess.
Yeah, and just things like, people that try and do their own, I'm not saying that business owners aren't commercially savvy. It's not about trying to say they can't understand it, because obviously they will have their own discussions and be doing it. But it's how will things impact that later forecast. So, for instance, we do only do financial due diligence for people if that's what they choose, if they've got a commercial team. But it doesn't always sync as well as if you do the full due diligence, because, for instance, if we do the financial only, we'll do a top level forecast. Mm-hmm. But if you want to get into the trends, which we know, seasonalities, the accuracy of bookkeeping month on month, profit margins, those trends show a lot about a business. Because if you see poor trends, they've got poor bookkeeping. So that means fundamentally there's a bit of, then can you actually trust the overall accounts? Because if they haven't got answers to things.
Yeah.
And for instance, they'll always say, sellers will often say, oh, my accountant just did it for tax purposes. That's fine. But why haven't you got an adjustment then show it without that for tax purposes?
Sure.
Those sorts of things they should have ready. This is what the seller should have ready.
Yeah, so useful.
Because why wouldn't, because it just means a little bit. And if your accountant's doing it, and the accountant knows you're selling, then this is when you might want to bring third parties in, because why wouldn't you already have the adjustments there ready? I don't think you should be going into due diligence about those types of reports. But things where it impacts would just be things like, okay, your top 5 biggest customers. Okay, so fair enough, you can look at the contracts, you can look at when does it own, but how quick do they pay? So we always see sellers go, oh, they pay within 30 days. But what do your debtors they show? How quick are you paying suppliers? What do your creditors they show? Things like, is the business trademarked? Because we have partners where we help with trademarking in our full due diligence. We would help at least a basic trademark search. But if it's not trademarked, what's the financial consequence of it? That's the question you're asking, isn't it? If in the commercial and due diligence process you find things, in the end, the biggest risk is a financial consequence. So that always it's always the accounts that end up with the impact. That's why finance become a key part in the whole overall end-to-end planning of a business, because it's the budgets, the cash flow, and the finance that are always impacted at the end if something goes wrong. Like I say, even if by employees leaving, fines, suing, customers not paying, things like that all impacts the cash flow. So when we do our commercial scenario plans, we would really be delving down into not only the baseline of the business, because obviously there is a historic trend, also what does the buyer want to add on to grow the business, because that's obviously a key part of why the buyer's buying it, but also looking at what are the potential risk and budgets they might need in the forecast, the upfront fees, do they need to replace a role? Have they got enough staff? Are they behind? Are they understaffed? And then just budgets in general, should they have a provision for recruitment fees if they might need to, what would happen if 3 employees left? Because it has happened. Because we always know engagement in employees is a risk post-acquisition, because they might not like the new structure. So there's a risk that it could happen, quite a high risk, I think. And what does that do? So then I always think you need, like, what's the worst case scenario, what's the best case scenario, and then a bit of scenario planning so that you can play around with the models to see. And that's what we would call commercial. Yes, there's asking questions, things like costing, but in the end, what do they do to the cash flow and the finances? That's going to be the critical thing in the end, because it's going to be that sustains the business long term.
Yeah, really useful. I mean, with the staff as well. I mean, it's always a sensitive issue as to what stage are they or some of them informed about the sale or the acquisition. That's often a sensitive topic where, again, collaboration has to occur, and when that happens, because that can be, it then drives into that commercial risk of what the reaction is going to be, or not going to be. So all really, really important. I mean, on the legal side, I mean, due diligence this is just so important on a range of issues. I mean, I think there's certain areas that whenever we're doing an acquisition, we would look at certain things straight away. We'd just get straight on it because they're just so important. Things like intellectual property protection, property. So if there's a leasehold or freehold property, then that's going to be critical because it's going to be either directly or indirectly a sizable chunk of the value of the deal. So we'd want to look at that really, really closely, especially if the business relies on its property, on its premises, which can be the case. But then even just other things like, outstanding. So if there's, like, I don't know, secured loans in the company, then we want to make sure those are going to be discharged at completion. But not just that, we need to make sure we've got the right paperwork as well, the right releases from those lenders to make sure we've got written evidence that there's no outstanding amounts owed to those lenders post acquisition, because that's really, really important as well. There could be some kind of historic loan that's covered by, that wasn't disclosed, that the seller thought was paid off, or probably maybe like 99% paid off, but it wasn't. And then actually the lender's security isn't released after completion because, oh, we've got this historic loan where there's, X amount of interest outstanding, we're not releasing our security. So that can happen if you haven't got the right checks in place and you're not making sure you've got the right confirmations throughout the due diligence process and paperwork, ultimately. So again, even with like commercial stuff that you were talking about, the legal aspects overlaps with that as well. And again, financial, because as you say, it all feeds into financial impact on the business if those risks materialize. So things like change of control clauses in contracts, it could be that there's, I don't know, key assets which are on, I don't know, hire purchase agreements or high value hire purchase agreements or financial leases, that kind of thing. And usually you'd want to look for, if there's a change of control, whether those financial products can be called in. That is definitely a legal risk that we see a lot, because someone that's providing, asset finance or any kind of lease arrangement are providing it to the company, but with the trust of the current owners, right? And how they've operated the business. But if there's a change of control, then that would then need to be reviewed. And usually there'd be a clause in there to allow those products to be withdrawn, which you obviously wouldn't want if you're acquiring a business. So those checks are really, really important to make. And there's other things as well. Are you registered for data protection? Those kinds of things you see cropped up. Is it all renewed? And there can be financial risks associated with that, and reputational risks as well. So yeah.
Yeah, there's a big risk, and I think our experience of post acquisition is operations do usually drop, because what typically happens is the buyer doesn't want to work in it, which is fine, and they might have all that sorted. Maybe the old owner's staying on, but then what's that relationship like now that owner's being managed? A lot of buyers will come in and want to have KPIs and the forecast, and these employees just aren't used to doing it, and by sort of, obviously you've got to try and put that in place, but you've got to try and put that in place whilst managing the expectations of those employees to a point, because you can't just come in and start dictating things that they haven't done. You might have employees that have worked there for 10, 20 years, never been asked to do it. And it does cause, and that's where like our experience as CFOs and financial experts is where we help, because obviously we've got experience from that from corporate. We're in our corporate world. We used to work with we would work with the whole supply chain, like all the directors in the supply chain, and help them with their budgets and help them manage it. And we've got that experience of, I suppose, business partnering with different areas. And maybe, if you haven't got that experience, we have seen people do it in quite dictatorial ways, and it does cause operational problems. We have seen people leave and, bad relationship with employees. And ultimately, in the end, if the employees become disengaged and the operations drop, just that alone will cause a cash flow issue. Yeah. It's getting them engaged and which is why meeting the employees as part of the due diligence process and having conversations, I think is quite important as well. And making sure you bring on a HR expert for your deal as well. Make sure there's no issues on the employee side. And, getting an org chart and find out who the people are. The amount of times we see, it's a finance director and it's actually the owner's wife or husband. They're not a qualified finance director. Yeah. They've just put them in that role because they've done the bookkeeping for all the years. And obviously, I think as a buyer, they want to start getting the right people in place. And often buyers do typically invest, I think, especially post-integration, on the right type of thing, the right roles. But the question is, do they know what the right role is, like who the right role? Because that's one thing we would look at in due diligence, is we'd look at the finance team and say, where do we think the risks are? Because ultimately, if that buyer wants cash flows and reporting relatively quickly after acquisition, if they can't even produce a monthly if they don't have anybody to produce this monthly management account, it's not just going to happen after acquisition, because someone's going to have to make it happen.
Yeah, absolutely.
And that's why, and this is where additional budgets like this consultancy post acquisition, the sellers never invested fully in the finance team. We see businesses of 5-6 million without a CFO. And you'd be looking at parts, they're probably not spending 50 grand's worth on finance that they should be spending. Oh, wow. Just the same, they might not have a HR advisor, they might not use a proper IT firm and things like that, which might be, underestimating. And this is the type of thing we would look at as part of our sort of budgeting forecasting, because I think that's the most important thing, is the buyer building their own taking the sellers, if they've got it. Normally they haven't, so they have to do it from scratch. But then taking it and building their own as to what they think needs in. Now, they might choose to then, sometimes it might be immaterial, like the odd £100,000 here isn't going to materially change the deal, but it is a cash impact.
Yeah.
And ultimately, paying back loans isn't a profit impact; it's a cash impact. So it's all a cash impact of what the cash flow will do after acquisition.
Yeah, well, cash is king, they say. So
yeah.
And particularly post acquisition, that immediate period is obviously critical, right? And that's what buyers are looking at straight away, right?
Yeah.
So yeah, really important. So on the due diligence side, do you work closely with the lawyers as well in the due diligence process, or do you kind of just do it as a side? Because usually the seller side will set up a data room, like a sort of an online sort of portal to host all the documentation, disclosure documentation, and would you usually have access to that and sort of be able to review everything there?
Yeah, I mean, we do like to keep in contact with all the advisors on the deal, because ultimately, in the end, they might share information. I suppose where we have our biggest involvement would be warranties. Yep. So what we typically, obviously, I know there is normal standard clauses, and maybe it's something you could touch on, is what are the standard warranties. So for instance, tax is usually a warranty that, if there's a tax audit for historic tax, the seller is usually liable. But sometimes we might find specific things where we might recommend additional warranties, more for disclosure. I don't know whether, and this is why we liaise with the solicitors, because we don't always know, is it a warranty or is it in the disclosure notes or things like that, where the best place to put it is. But like, as an example, if they've got invoice factoring and we've done the reconciliation on the balance sheet integrity and they can't reconcile the number, there's a risk.
Yeah.
And the discrepancy will be a percentage risk. And if we see big risks, well, ultimately is down to the buyer if they want to proceed, because this would be times when is there a time if the seller's books are so bad, would the buyer pull out? But ultimately that's then down to, we would never tell the buyer what to do. Ultimately they can choose their own risk profile. But we would just highlight, and if we did see if they did want to continue, we might recommend an additional clause. Obviously it's then down to them to work with so we would probably say it in communications. We would then expect the solicitors and them to pull up the right terminology, because we don't know the legal terminology to protect them.
Yeah, absolutely.
And we have done that and it has worked, because the reason we do it though is we would let the solicitors write the legal words. Obviously most parties don't understand the legal terminology. We would focus more on explaining to buyer and seller the reality behind what we found, so that both of them, so that seller understands the risk as well. Because ultimately if it happens afterwards, if something does come through tuition, the seller might know, oh yeah, well they did explain that. It might just make it easier to have those conversations about having to go down the legal route to enforce it afterwards. And then obviously we would expect the solicitors more to write the legal to protect the buyer from that element of it.
Yeah, absolutely. And we frequently work with different types of accountants on that, where we've had feedback, oh, you need to put this protection in there, go and put it in the right way or whatever. We might draft it and say, do you think this wording is okay? Is this wide enough or whatever? And to an extent you'll know, to an extent you might not. But I think, working together is always good. And I think it's just about getting the right protection. Yeah. But even, talking, when you were talking about just explaining the implications to the buyer, even if there is legal protection, I suppose you've still got to deal with it. In the first instance, you might be able to enforce a contract, but you then got to go and enforce it. But in the meantime, you've then potentially got an issue to deal with. So I suppose those are the conversations you're having in terms of saying, well, how are you going to deal with this whilst then enforcing this contract? Obviously, we deal with the enforcement side of it. And then in terms of, I suppose, usually if the price is subject to an adjustment based on the financial position on the completion day, which we call completion accounts process, we would usually request input from people like yourselves on sort of what those, how quickly they can be produced, the completion accounts, whether there's any specific policies that should apply to formulating those. Do you support with all that as well?
Yeah, well, it would depend what we do with the buyer when they've bought the business and who the accountants are and bookkeepers and things like that. I mean, ultimately, normally a bookkeeper would transact. So that and we have bookkeepers now. So if, if someone's just on deal 1 or deal 2, we do often become like an outsourced bookkeeper. I suppose if the accountants and the bookkeepers have transacted quite well within the acquisition process, it might be we don't need to do that afterwards. Our ultimate isn't always to do everything. Sometimes some are better than others. Sometimes it has been really poor. Sometimes it's been okay. And we often on the integration we do mentor, train and help on board junior staff as well. So if eventually people need it internally, then we can help them do that. Or we would help work with the staff that are already there. And maybe our role might be to help train and oversee them if maybe there are some risks in it. So I think it would just depend who the team are on top. It might be they do it and then we review it. It's a secondary check, or it might just be they didn't really have a team. It was an internal admin doing the bookkeeper, and they just need the support, and then we would come and do it. So it would just depend on who the team are. But I think one of the biggest problems we see in acquisition is people trying to promote people because it seems like the easiest thing to do. We've seen people promote, finance staff to maybe finance managers, and they don't really have, it's unfair because they haven't got the skills and experience at that time to do it. It doesn't mean they can't study to become it, but it could be unfair on them. And we also see it, people being promoted to managing directors and CEOs and things like that, just because they've been in the business 20 years, but they might not have the skill set to do that job.
Yeah, that's so true.
And I don't, and again, sometimes this comes down to money because people do it for admin reasons, like simplicity. It's just easier to promote someone. But this is why they want to have good conversations in due diligence to get a gauge of who the employees are, to see, do they think there's anyone capable. If they don't think there's anyone, if their gut is telling them, the buyers, their gut's telling them they haven't really got that person, either someone, the seller stays on for longer and trains someone up if there's someone close ready. And if there's just not that person, then they might just have to recruit. But it's not always, but time, in the end, once they become busy after the acquisition, that's why you need the support post acquisition as well.
Yeah. Yeah. So I guess that nicely moves us onto that topic as well. So in terms of like the post acquisition integration, that kind of thing, do you want to talk about the importance of that and what that involves?
Yeah, so I had there was a guy that came on my podcast, Adrian Knight. He talked about post integration. He actually had to stop acquisitions for a whole 12 months to integrate back office. There is a lot to do in integration. Now, we don't deal with all post integration. Our area of specialism is the financial and the corporate governance, although that does touch on, I think, quite a lot of areas. I think the key integrations are IT and systems. Now, we can help with the financial side of that. So we can help with accounting systems and things like that. But obviously, there could be other systems like CRMs, product systems, and that's not our forte, So you need to make sure you've got specialisms in those areas. Where we would help, for instance, is if there was a sales system that needed to link to the accounting system, we would check the integrity of that feed. So we would be like, is there a reconciliation in place to make sure the numbers are right? But ultimately, the workings of the sales system, you'd need someone that knew the sales system. And stock systems, for instance, who's putting the stock on. The amount of people that have got stock systems, no one actually puts the stock on. Like, it's incredible. So there's a lot of integration. So how we would start, we typically start with a minimum of 12 weeks. It's normally a minimum of 12. It could go on for longer, depending on where the business is. And it would be an extension of so I suppose in the due diligence, we'd be doing a 5-year plan, a top level 5-year plan with a 12-month detailed. And we would extend on that 12-month post acquisition. So one of the things we'd be looking at is who are the decision makers. If there aren't any, we need to get them, because you need decision makers in the business to make decisions. And obviously and hopefully the seller might have decision makers in the business when they sell it, but if not, the buyer would have to put it in. And what we'd start by looking at is feeding that as a bottom-up budget. So start cascading that budgets into KPIs, into teams. Because ultimately, in the end, the business performs as well as its staff. But if you need a HR person there to sort of oversee, I suppose, how well are the employees doing, how are they remunerated? But ultimately, they need to have the targets in the first place. And the targets, need to come from some form of KPI. And KPIs are normally driven from financial targets. Not all of them are financial KPIs, but for example, stock turnaround, that would be a fact. But I suppose a non-financial KPI could be number of customers retained. But in the end, that customer retention will change the budgets, because it might change the marketing spend. Because obviously, if you have a higher number of customers retained, it's a lower marketing budget for so that's where it all interlinks. So that's why like a financial team's good, because we can help them build the KPIs and how that looks in a monetary form. Because you have to be able to report on them somehow. And that's what we would do, is we'd start with that. But if they had a poor bookkeeping process, we'd also be saying, like, before we build, because everyone's just like, I want a management accounts. I'm like, if you've got poor information, you can't have one. You can have a budget, because obviously you can build the budget, but obviously you've got to remember that budget's been built off a foundation that's probably wrong in the first place. So you've got to go back to basics. If it's wrong when you buy it, you've got to go back to basics and fix the basic bookkeeping first. And this is why we're trying to so incentivize the seller to get these things in order, because obviously the more the seller can do, the better the business runs at a basic level. When the buyer buys it, the easier it is for the integration. Because obviously if the seller had good bookkeeping, management accounts, and a seller pack, and a 12 weekly cash flow, imagine how easy it is for the buyer. And imagine how they'd be paying over they'd be willing to pay, wouldn't they? Because there isn't anything they have to do.
And then they take a view on other things that maybe aren't so perfect. Like certain legal issues that maybe aren't so material, and it just it goes back to like maximizing value as well. Because
if someone came to you before they were going to sell to say, could you just do an audit of my legals?
Absolutely.
I presume that's the sort of thing you could, because a bit like how we're doing the exit discovery, I'm presuming you could do the legal discovery.
Absolutely. And we would do an audit where we do a report effectively. It's almost like a mini due diligence exercise, I suppose, not as detailed, and then we would just flag issues in terms of and actually allocate them in terms of importance as well, and maybe like a risk level or something. So one of the main things that I just think of off the top of my head is things like creation of like assets. So, website assets, for example, who logos, let's say. So who actually created the logo of your business? And if it was some external party, then do you actually own the copyright to your logo?
Mm.
And more often, we frequently see where there's no paperwork in place. Oh, they designed that 20 years ago or 15 years ago, and we're not in contact with them anymore, or they still maintain our website. Well, sorry to say, but they probably own the copyright in your logo, unless there's some kind of assignment to your company. So we would then flag and say your buyer is going to raise this as part of the due diligence exercise. Let's reach out to them now and get a written assignment in place. Okay, now your company owns the right intellectual property. So those kinds of things can be done in advance in an audit process. I suppose sellers don't necessarily think to do that early on, although they ought to, or maybe they don't necessarily want to, in case, I suppose, maybe cost saving on the one hand, maybe to an extent, maybe they don't necessarily want to know yet. They're
Yeah.
not ready to know yet.
Yeah.
That kind of stuff. But yeah, I would highly recommend a legal audit and a financial or even commercial audit prior to, well prior to sale.
But that's why, I mean, I would recommend a seller to do more of like a corporate governance session, because the point of the corporate governance is the safeguard to look at the overall business, to look at where are the risks. Now, it's not saying they have to implement everything right away, but ultimately, in the end, sellers sort of burying their head a little bit and not being open to the truth is what ends up causing the problems in the acquisition stage, because at the end of the day, you've just got to know the truth. If the truth is, because you can probably fix it.
Yeah.
But ultimately, you've only got, there'll be warranties. The buyer will pick it up. There'll be warranties in the SPA. And if anything then comes back, the seller's going to have to deal with it anyway.
Yeah.
And it's like, and as a seller, you've got to decide what risk level, like the buyer's got to decide what risk level they're going to be willing to take. I suppose the seller's got to decide what risk level they are. But what's interesting is they don't know.
Yeah.
If you know and you've chosen not to do it because you think, oh, it's a low risk, high cost, I don't think it's worth it. And that's your choice as the seller, and you can make that choice and have that. But, then be open, have it written, say the reason you haven't done it. It's transparency, isn't it? You're telling the buyer, it'll make the deal go quickly, because the swap will be there, everything will be there. You'll be telling the buyer, this is what I've done, this isn't what I've done, this is the reason I haven't done it. And the buyer will be like, oh, this is a good business.
Yeah.
This is a good business to buy. This business is set up well. It's not always about everything being right and perfect. We all learn as we go along.
Yeah.
But it's more about the fact that when a seller just doesn't know anything about their business, apart from the seller's often goal is just customers and sales. They're not always thinking about the admin and the controls around the business. And that goes for a lot of things: cyber, IT, HR, brand, insurances, like all legals, and finance to a point, because they're so busy all the time. They sometimes think, oh, I need to do this, and then they just never get round to it. And we have a lot of conversation with people where they have invested money in their accountants, but they're telling us, I don't think I'm getting it, because they've spent that money, they don't want to invest it again. And it's just like, I understand that, but at some point you have to just accept if you're not getting what you think you need, even if you have that open conversation with them and change it, or you've just got to accept it's a sunk cost and move on. Because going on for years, paying for something that you're not actually getting the benefit of in the end isn't worth it either, because it just delays everything. So I understand why it's hard. It is hard when you're in a business, so much to do. But that's why you need to be willing to invest in the right resource to help you. Because obviously everybody would do their part. You would come in and do the legal audit. We could have a look at the financial and governance exit audit. HRs could probably do a HR audit. You can bring in the right advisors to do the right things. And then you don't, have to do, like in our business, we're only, just over 3.5 years old, and we're fully trademarked, we're fully cyber protected. We've got a HR firm, we've got an online holiday portal, we've got management accounts and KPIs. They're not all perfect, but we've got them because we're implementing them, because we're getting more staff as time goes along. We've got key man personnel insurance for key employees in the business if they go. And we've invested in that, and like, we're a small business, cash is sometimes tight for us, but you can't always just go on the money going out of the bank today. You have to see so I did a cyber episode on my podcast, and there was actually an accountant example the cyber person gave. Basically the people came and basically harass all of their clients. They basically frauded all of their clients and pretended it was the accounting firm. Basically
wow.
said, you've got to give me money. The accounting firms give me your details. They hadn't, obviously. This was a cybercrime. There was a lot of examples on there where people lost millions.
So scary.
Millions in cash because of cyber.
Traditionally, you'd think, okay, let's say solicitors practice target for criminals. We're going to get attacked. We're going to get held to ransom or whatever. But then if to think that if all my clients got attacked, saying that I had sort of released details, I think I'd be completely horrified.
Yeah.
And actually, the clients may not actually have the protection in place that we would have, knowing that we're a sort of a prime target, I suppose. Yeah, that's so scary.
Yeah. And things will still go wrong. We're ICO and we're always looking at our systems and our security. And it's things like that, isn't it? It's like safeguarding not only you, but your customers and suppliers. Because, at any time, you are probably, especially in these days, there is more risk of breaches these days.
Yeah.
So there's lots of things, and I think that comes down to a plan, doesn't it? A bit of a corporate governance plan, and just thinking of where are the risks in the business, what have I got in place, and what budgets might I need, and that's probably where we come in. Obviously, we don't resolve all of those things. We're not an IT firm, we're not a HR firm, but what we can do for people is help look at their budgets and their cash flow, and look at so when are you going to start bringing them in? Like, that's the point. That's why you've got to start planning longer term.
Yeah.
When do you want to do it? Because you've got to have actionable targets. And who's going to do it? Like, maybe there's an administrator in that can manage, like, just save all the insurance documents down and know when the insurance is going to renew and go to market and get a few quotes. That's how the owner gets help, isn't it?
Yeah.
They get help by bringing that resource in. Giving them their actionable targets, and then those, and then they just get the 3 quotes, and make the decision, like that sort of thing.
Yeah, and it's good to have that plan in place. It's like, okay, we're not going to do this now, but we're going to schedule this in for 6 months time or whatever it is, and that's you sleep much better, I suppose, knowing that that's happening. Whereas alternatively, it's in the back of your mind. This needs to happen. Oh shoot, I need to do this now. Oh, cash is tight now. Okay. I won't do that, or I have to do it, and then I'm going to suffer a little bit. So, yeah, really, really good, good insights there. And so, I mean, that can happen prior to sale. That can also happen post acquisition as well, I suppose.
Yeah, I mean, one of the things I'm trying to do with the podcast and what I'm doing in the industry in general is trying to get more educated sellers. Because I do just think if the seller could do it, everything would be a lot easier. I think they would get more money. I think they would sleep better, because obviously what we're trying to do is help the seller transition their own business to be an asset rather than a lifestyle. And actually, sometimes seller doesn't even always need a full sale. There are employee trusts or management buyouts and things like that. And ultimately, if you can get the business to run independently, not only might you not have to sell it all, because why would you want to sell something all of something that's making you money all the time? It's a bit of a retirement plan, isn't it? Although you might choose to. I do think best practice is for the seller to try and get most of it in place. But I realise we're probably a long way off that, because most sellers probably have 2 years worth of work to get it fully. And in the end, you've got to find the sellers, the businesses that are willing to invest to put that in. But ultimate deals are going to happen. So buyers, if they are buying these businesses where they're not in place, then the next best thing is that we help the buyer safeguard it and put it in place. So essentially, we would do the same thing with the buyer as we would with the seller, because it's the same. It doesn't change. The business needs a level of safeguard and governance to make it run effectively. And it doesn't matter who the owner is. That should be in place to safeguard the whole company. And we would ideally think it's best practice for the seller to do it, but if not, buyer comes in and does it. And that's where you've got to be able to negotiate those things on the deal, isn't it? Because some things are low, in that it's high, maybe high risk but low spend as well. So they might just like take it on the chin and do it. You don't have to discuss every £5. That's not what I'm saying. But at the end of the, but you do need to know. Especially when you've got like man with a van that's signposted all over the vans, and you don't own the trademark to the company.
Yeah, that could be a tough situation.
Yeah. And it happens. So, yeah, because I think a lot of businesses, the one episode I actually released today with Matthew Cusack, he does trademarks and IP. And he said he was in a room with 20 people. Ask them all who's got a brand they've built, all put their hands up. Who loves their brand, proud of it, all put their hands up. Who's protected it? Only one person out of the 20 had their hand up.
Oh, wow. That's
So
crazy.
yeah,
Yeah.
because people are thinking because they've set up their house, their company on company's house, that they're now, which I understand why they think that, because I do
Yeah.
understand why you would logically think that if you set it up on company's house, it's available, I can have it.
Yeah.
But like he uses as an example, if you're in Colchester and you set yourself up as Adidas Colchester, would Adidas let you do that? Or if they found out, if you became relatively big though, maybe it doesn't matter if you're small fry, but if you've got visions to be big,
Yeah.
it comes a time, imagine if you've now got 15 employees and you're at 3 million and suddenly Adidas come knocking on your door and go, you can't use that brand, you're infringement on my brand.
Yeah, I know it's happened. I know a few people that's happened to.
Yeah, yeah.
We have a few clients that were effectively startups, but they've grown very quickly in a short space of time. And we help them with their sort of ongoing legal stuff. And I think that they need to do that, or are doing it, or have done it in certain respects. So it does vary, but I suspect there's probably more people that haven't done it than have
And it's
done
so
it.
cheap. You can trademark your business for about 700 quid.
Yeah.
And it's like he said, you might spend 20,000 on a van, probably another 4,000 to market it. So you're not willing to spend £1,000 just to protect it. And sometimes it's not even not being willing, it's just not knowing. Not thinking about it, which is why you want a plan.
Yeah.
Because it's the plan that ultimately gives you the thoughts to think, yeah, I've got to go and do that. Because sometimes it's just busy lifestyles and you forget to do it. So that's kind of what we try to help with. And I suppose that's where our corporate governance side and commercial side comes out, is we're a lot more than just the numbers. Like I do think, building the model is one thing, but understanding it and actually using it, and your teams being able to use it is another thing, isn't it?
Definitely.
Yeah.
Really, really, really amazing insights there. So if there are businesses out there that want to sort of reach out to you, or just learn more about the services you provide, how is the best way to reach out to you?
Yeah, so I'm on LinkedIn, Julie Wilkinson. I've got Profit Queen after my name on LinkedIn.
That's how we met, isn't it?
Yeah, Profit Queen, yeah. I am on Facebook, TikTok as well. My email is julie.wilkinson@wilkinsonaccounting.co.uk. I do have a PA, so her phone number's on the website, so you can get up to her because she books the appointments. And I'm actually doing a Buyers Academy in 24. I'm launching a new Buyers Academy to start helping, because I've spent about 18 months listening to buyers. I get a lot of them phone me. I think maybe because I do think partly it's because I'm a woman, because I think because there aren't many women in the industry, I think sometimes what I hear is it's quite ego driven. I don't see many women. I've seen a couple of women buyers, but not many. But I do get a lot of male buyers just phoning. I think sometimes it's just nice to talk outside of a group environment. And the things I always hear is it's quite ego driven. There's not that much financial expertise. So, a lot of all this money down deals, but in their head, the things I'm saying here, like the cashier, they are thinking it. They are thinking, but how do I manage that after acquisition? But there's not really the help in the groups, or they don't feel comfortable saying it. So I'm going to take all this experience with all the acquisitions that we've done, and I'm launching this Buyers Academy next year. It's going to be, each cohort's going to have up to 5 buyers, and I'm going to do an onboarding call with them. And obviously I've got partners in the industry for brokers and finance brokers and legals and things like that I'll help match to what I think they need. Plus we'll have like weekly accountability calls, and they'll get partner rates with Wilkinson's on the due diligence. So we'll give everyone gets a valuation report included as part of the package, like a top level valuation report, one included in because each cohort's 3 months. And and then if they do want to use this, obviously they don't have to use Wilkinson's in due diligence, because this is going to be me running it as a separate company, but we will give partner rates for Wilkinson's, so they'll get a bit of a discount on the due diligence as well to help bring the deal together.
That's really, really exciting.
Yeah.
Look forward to seeing that. And if there's anything Birdi and Co.
Definitely.
We'd be happy to sort of discuss that. So I think just drawing this to a close, then it's been an absolute pleasure to speak with you. Thanks so much for making yourself available to talk, and all of the insights that you've given is going to be so valuable to, I know, whoever's listening to this. So thanks very much.
No, thanks for having me.